All right. So thank you everyone for joining the call today. We appreciate taking the time. The purpose of today's call is really to go over, um, the general employee retention tax credit and hopefully give you the tools to have great conversations with your prospects and be able to answer their questions along the way. We will go through all of the slides and hopefully give you guys a great starting point to springboard those conversations. And then we ask that if you have any questions, just reach out to us after the presentation. We don't want to take up anyone's time. A lot of clients have very specific situations. So just so that everyone can, enjoy the rest of their Thursday, we ask that questions just be sent to us afterwards. And everyone should have Brian's contact information. So Brian and Mark could funnel them through. I'm Marcela Osello. I am a CPA. I'm sure you've seen my name on a lot of the BQF reviews that I've been doing, but I'm also dabbling in the employee retention tax credit. In terms of my credentials, I spent about 8 years in Big Four public accounting. That's where I saw most of my R&D exposure. Then I went off to a smaller firm, and now I am on my own living the freelance freedom life. So let's start. So here's our agenda. We're going to just go over the basics of the ERC. We'll go over some definitions of who are eligible employers, what are eligible wages. We won't go into the ins and outs of calculating the actual credit, but just, high level how it's calculated, how typically we would be claiming the credit for our clients, the common documents that we would request of them. And then there's some clarification items, which are, little intricacies that the IRS has come up with that really impact a lot of our taxpayers. So basically, the ERC is a tax credit that offsets the payroll tax credit. The purpose of this credit was really during COVID to incentivize employers to not do a lot of layoffs. So that was the general point of it. It is a refundable credit, which means that you can get cash back in excess of your tax liability. So, if it's non-refundable, the way it works is if you owe 10 grand and you had a credit for 15 grand, you can only use 10 grand of it to offset it. You can never get money back afterwards. You'd have to carry it forward. But the refundable one is good because you can actually get cash back in excess of the liability. We would be claiming wages starting after or on and after March 13th of 2020. So in case a client asks, that is the start date of the qualified wages. And the number of employees doesn't affect whether a company may claim the credit. It just affects how we're calculating qualified wages and what kind of wages that we can use. And we'll go over that in a succeeding slide. So in 2021, we had a big change. They extended the ERC now for wages that are being paid in 2021. The biggest change, a lot of it has to do with PPP. For 2020, anyone that got PPP could not even think about getting the employee tax retention credit. But now certain clients can be eligible. It's not, eligibility across the board. There are certain factors that need to be met, but at least now they have a chance. They also lowered the threshold for a significant decline in gross receipts, which is one of the qualifying factors. So we'll go over that in a future slide. They extended the credit, of course, so that now you can get more money back for the qualified wages of your employees. And they altered the definition between large and small employers to be 500 plus being large or 500 or less employees being a small employer. So who is an eligible employer? So it's any private sector business or tax exempt organization, no government entities, and they have to carry on a regular trade or business. Regular trade of business is the same definition as, if you're filing your regular tax return. So if they file a tax return as an entity, that's usually a qualified trade or business. They have to have one of the two events occurring in order to qualify as an eligible employer. Either they had a significant decline in gross receipts during any quarter of 2020 or 2021 compared to 2019, and we can go over, the ins and outs of that, or the business had to be fully or partially suspended due to federal or state government orders that limited travel, any shelter in place. I know Cali had to deal with a lot of that. So any kind of significant suspension, either full or partial, due to any state or government mandate. So a significant decline in revenue. For 2020, they would have had to decline by at least 50% of the same calendar quarter in 2019. So if in, Q3 of 2019, they had 100 grand in gross receipts, Q3 of 2020, they had 50 grand of gross receipts. That is a qualifying quarter. In 2021, they expanded that to make it a little bit more lenient, saying that in 2021, if it declined by at least 20% compared to 2019, so instead of that 50% decline, it's only a 20% decline, which really expands the eligibility for a lot of employers. Now, for fully and partially suspended, we have a little bit of wiggle room here. It's pretty straightforward. California obviously had the shelter in place. That is, a pretty straightforward full or partial suspension of, your operations. But there's also, some wiggle room where if it's not, a full suspension, but they had to limit their operating hours or reduce their operating hours, that may qualify as a partial suspension. If they are in an essential business, for example, essential businesses wouldn't really be subject to any of the government mandates. But let's say that their suppliers or, and any of their, in this case, the supplier that is a big part of their essential business, they were non-essential and they were limited by, the shelter in place. In that scenario, that essential businesses operations are also limited because they now can't get what they need from their suppliers. So in that scenario, that could possibly qualify as well. It really just depends on the circumstances, but we can go through that. If a business had the shelter in place, but continued to operate almost the same via telework, if they were still, running pretty smoothly, then that one, we may have a little difficulty qualifying because, they didn't really have a suspension of operations if everyone is still able to work, from home and you're still able to run your business from home. So an order from an appropriate government authority, that's just the definition. It can be from the city mayor, it could be an emergency proclamation, like the shelter in place example, any curfew, that is what I said about the partial suspension because it's limiting your operating hours, and any order mandating a workplace for cleaning and disinfecting. So if, typically you're open for 12 hours a day, but now you have to impose all of these cleaning and disinfecting that now, diminishes your operations to 8 hours a day instead of 12, that is a partial suspension of your operations. Now we're going to get into qualified wages. So qualified wages would be your regular, salary wages, hourly wages. They can also include qualified health plan expenses to the extent that they are not included already in that gross wage that you're reporting, when the client is filing their quarterly tax, payroll tax forms. But with qualified wages, the IRS does not want to let anyone double dip in the benefits. So if they are claiming the Family First Coronavirus Response Act, the Work Opportunity Tax Credit, or any other tax credits where they're utilizing those wages as a qualifying factor, the IRS says, no, you can't double dip, you can't get the ERC. If there are wages outside of that pool that weren't used for those credits, then we can. It's just, going to probably be a slight administrative burden for your client to collect the information that kind of really allocates what was counted for those credits and what wasn't, but it's certainly doable. And then for the forgiveness on a PPP loan, if there are wages that weren't, as part of 2021, if there are some wages that weren't used for PPP, that is one of the PPP exceptions that they're allowing for 2021. There are a few other exceptions with PPP, but when it comes to the double dipping of qualified wages, in 2020, it was a complete no. If you have PPP, you cannot. But in 2021, it's if you can show us that those wages weren't for PPP, then we can let you slide. And then most importantly, no wages from relatives. So that includes no qualifying wages from children, parents, siblings, aunts, uncles, or aunts and uncles. I don't know. We've got a lot of people from everywhere over here. Grandparents, step parents, step siblings, mother-in-law, father-in-law. So the IRS got pretty detailed with their definition of relatives that could not be included as qualified wages. So when we're talking to our clients, we need to ask, do you have any relatives on your payroll? Because we kind of need to mark them off and make sure we're not including them in our calc. So this is for 2020. This is just high level how we're calculating the credit. The most important piece or takeaway from here is really if your client has 100 employees or less, then we can use all of the wages, assuming, they didn't use it for other credits. However, if it's a larger employee, then we can only use wages for the employees that are not providing services. And that really just means, let's say a large employer had a full shutdown, but was still paying their employees, all of them, regardless of whether they were able to work or not. We would only be able to include the employees that were not able to actually provide the services, that were just getting paid, really just, to retain them and not let them go somewhere else. And then the other piece that we will need to know from our clients is their average full-time employees in 2019. And the IRS defines full-time as working either 30 hours a week or 130 hours a month. And we would need to take the average amount. So we would need to know if they had a lot of turnaround, we would need to kind of break it down by month and then figure out an average. If they don't really have a lot of turnaround and we get close enough with just, all of 2019, I basically had the same number of employees, then we could just use that for the full time. For 2021, the only change here, obviously, is the actual amount that we're getting back. But in 2021, the definition of small and large employer is changed so that it's 500 and less is the smaller employer where all employee wages are eligible. And the large employer at 500 and more, that's the one where we can only include for the employees that were paid but weren't actually working. So this is just an overview between 20 and 21 that we went over in the previous slides. The percentage for the significant decline in revenue for 2020 was 50%. For 2021 was 20%, so we get a little bit of leniency there. And then in terms of the calculated credit, in 2020, they would have gotten $5,000, which is 50% of 10 of qualified wages per employee per year. But in 2021, we now get 70% of up to 10,000 of qualified wages per quarter. So we've already almost gone through 2 quarters in 2021. That is $14,000 of wages that are on the table for credit, plus the 5,000 for 2020. That's where we're getting to the 19,000 per employee. And then, so the the caps applied annually and quarterly, we went over that. And then the potential benefit, that's how we get to the 19 in total. And if we think about all of 2021, if they're eligible, then that is, 28,000 in just 2021 per employer once the year is over. So how do we claim the credit? There's 3 different ways. If it's for 2020, then we would be amending their Form 941 for each quarter. That's applicable. If it's current for 2021 and they haven't filed a quarterly return, which is not really likely because most of our employers use third-party payroll processors who usually file the 941s for them already. So in most cases, we would be filing amended 941s. But they can also claim it in advance. So we would file a Form 7200 for an advance payment of these employer credits. For example, for even if the quarter's not up, we would just file that form. I think based on what I've been seeing so far, it's mostly the amended 941s. And they have the option with the 941s of applying it to, a future quarter, kind of carrying it back. But what I've mostly seen is them just wanting that refund. And then they figure out what to do with it afterwards. In terms of what we're going to be requesting from the clients after we ask, have the conversations with them, explain to them the credit, the potential benefit, whether they're eligible, what kind of wages would be eligible, we would need confirmation of any other tax credits they received, so we make sure not to double dip. We would need their quarterly profit and loss statements by quarter for 2019 through whatever, quarter we're claiming, if they're claiming into 2021. We will also need their quarterly payroll tax returns for each quarter. It's the Form 941 for 2019 and 2021. We aren't amending 2019, but the reason why we're asking them for it is really so on the 941, there's the number of employees. It's really just to double check, just to see how much everything was paid. And you'll see in the clarification items slide that there's a section about paying your employees in excess of what they would regularly be paid. And that will also kind of be a double check for us. We will also need to know the average number of full-time employees for each year, confirmation of any relatives on their payroll, confirmation that no severance wages are on their payroll because severance wages are not counted as qualified wages. So we have to make sure to pull those out. And then the weekly payroll reports for March 2020, because the qualified wages kind of happened in the middle of March. So we need to start at a starting point right in the middle. And then we can do quarterly payroll reports for the subsequent months, but we need to know details by employee. And then if they want to include their qualified health plan expenses in there, we need, the amounts that they paid. The qualified health plan expenses tend to get a little bit more complicated because we need to find a way to allocate it by employee. So we need to come up with a methodology if the client doesn't already have one. If they have a group plan, we can figure out, total hours worked and kind of backtrack from there. But the qualified health plan expenses, just know that it may be a follow-up item when it's submitted to the CPA. So here are some clarification items. This is really just helping in case the client asks you specific questions. For gross receipts, it's their total sales net of any returns and allowances. It also includes any kind of investment income in their company, like dividends, rents received, royalties, if they get any grants, if they have members that pay dues, all of that kind of income is counted as gross receipts. If a client bought a business in 2020, which was probably not a great time to acquire a business, the IRS still requires them to use the business's 2019 gross receipts pre-acquisition, so they need to talk to whoever they bought the company from. Usually when you acquire a business, you do get the prior year financials, so that may not be that difficult. But if they did acquire a business during 2020, we still have to use 2019 as the starting point. Like I said before, the credit is for the qualified wages being paid on and after March 13th, 2020. The average full-time employee calculation is used by taking the total number of full-time employees in each calendar month. You add them all up and then you divide by the total months. For 2020, it would be 12. For 2019, it would be a different number because we're not counting the entire year. And then for employers that averaged over 100 employees during 2019, so this is large employers, the qualified wages cannot exceed what the employee would have been paid for working an equivalent duration during the 30 days before, whatever happened, whether it was the shelter in place or whether they started experiencing the significant decline in revenue. And this is because what happened is when the SBA started, giving people EIDLs and PPP, a lot of employers wanted to be, generous to their employees to thank them for, working hard through the pandemic and increased their pay or gave them bonuses that they probably wouldn't have given them if they didn't just get this big payout from, the SBA or the PPP. So if they're a big employee, we would have to look into that. And that's another reason why those payroll reports from 2019 will be a good factor, because we kind of use it as a comparison to see if there was any significant jump in wages being paid out. For large employees, also during 2019, we cannot include wages paid for paid time off and vacation. This makes things a little bit more complicated from the CPA's end, which is why we need those detailed payroll reports if they're a large employer, because we'd have to kind of carve that out. I had mentioned before that severance payments cannot be included in qualifying wages. Also, any wages that are exempt from Medicare taxes or Social Security, we have to carve those out as well. For qualified health plan expenses, this is a good thing, that we can include both the portion paid by the employer and the portion paid by the employee if the employee is making that contribution pre-tax. And we could see that from the payroll reports. The qualified health plan expenses do not include HSA or MSA contributions. That's the health savings account contributions. But if the employer has a health reimbursement account, then we can include those contributions. And then the wages for the eligible employer can't include qualified sick leave and qualified family leave wages that it already used under the family, I can't even pronounce the acronym, but you guys know, the leave one. And it also has to do with qualified health plan expenses. So whatever wages they claimed under that Family Leave Act, we can't claim them under ERC. And that is it. I tried to make it as simple and straightforward as possible, really just to help everyone. I'm sure your clients will have a lot of questions on whether they qualify. And so if, the factors are kind of laid out in a easier way, we'll know, how we can have quick questions or quick discussions with them, know what to ask them for, and really get the ball rolling so we can all get our clients some credits. Brian, did you want to add anything?
Yes, I do. Thank you, Marcela. And had it not been for a few technical errors or problems at the beginning, I did want to take a moment and introduce Marcela. I know she gave a little bit of her background, but I will just say Marcela is a consummate professional, just incredible to work with, and knows so much about the tax code and accounting. And it's certainly our pleasure to work with Marcela. I know that was a lot of information that was shared in about 30 minutes of time.
Mhm.
I get that. And what I would encourage everybody on the call to do is really just like the R&D cases. I mean, interview your clients, obtain all the data, fill out the documents, the applications, and then submit that. And our tax professionals can go through the information, go through those files. We'll reach back out if there's additional questions, additional information that might be needed. But we're introducing this because, just with what was going on, what was available through the employee retention tax credits in 2020, it wasn't really all that exciting to us and really worth pursuing. Um, Whereas, as Marcella mentioned, with all the changes for 2021, it's opened up a lot more opportunity for a lot more employers to qualify, and for the advisors that are out there that are day in day out meeting with business owners. For those that have a lot of existing clients, this is something that you may take to them, and there be additional credits and opportunities. And it also could be a discussion with new clients. And it's really kind of, in my mind, fishing in a little bit of a different pond. A lot of our R&D clients, they may or may not be good candidates for this, whereas a lot of clients that we may never talk to about R&D may be great candidates for the employer retention tax credits. We're seeing some pretty significant refund amounts. And as Marcella showed, if you take the first 2 quarters of 2021 and you take the eligible amount of credits for 2020, you're already looking at potentially $19,000 for each employee. So as you can imagine, especially larger firms, that can become a significant recovery by quarter. So anyway, to wrap this up, I will tell you that we will be sending out later today, tomorrow at the latest, marketing materials, data collection forms, and you are off to the races. Any questions that you might have, reach out to us and we'll get you those answers more than likely immediately. If we need the tax pro like Marcella to weigh in, she's available and is always happy to help. So thank you again, everyone, for attending today's webinar. And Marcella, fantastic job as always. Much appreciated. So everybody have a good day. We'll talk to you soon.
Bye, everyone. Thanks for the time.